Target stock has been hammered all year, down 20% year to date, but is now a great opportunity to pick up this undervalued stock with a nice forward yield of 3.7%, where we can expect some strong share price appreciation as well as a yield on cost in the double digits over the next few years. Today's episode, we're going to find out, is Target a buy now? We're going to look at the historical performance of the stock. We're going to run into their income statements, look at that revenue growth year on year, as well as that bottom line, that net income growth. We're going to deep dive into their balance sheet, look at their cash versus their total debt. How well is the company truly performing? This is going to take us to that all-important dividend safety, as well as some very important financial metrics you need to understand before investing in Target. And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding out our acceptable buy price given our margin of safety. Now, it's being hammered week after week in the market. It is down 20% year to date, right there at that 52-week low with a very strong starting yield. Now, investors who have been holding the company over the last 10 years would have seen a return of around 90% without dividends reinvested. Now, 10-year investment, you want to be looking at a higher return than the 90%. And today's episode, we want to understand, can we see some very strong growth over the next 10 years, as well as some very nice dividend growth, and get that yield as high as possible. Now, in terms of the business itself, revenues, that top line, what do we like to see? We love to see around 3 to 7% growth year on year. February 2019, around 75 billion on that top line. January 2023, their latest annual report, around 109 billion. So it has grown over the last 5 years, which is very positive to see. We will look at the last 10 years on a percentage basis too. And what's good to see is that increase year on year consistently. And when we take a look at that bottom line, that net income, what do we see? Well, around 2.9 billion in February 2019 on the bottom line. Latest annual report, around 2.8 billion. So it hasn't really moved over the last 5 years. But on a more granular level, 2.9 billion, it has gone up all the way to the latest, or the second latest, January 2022 annual report of 6.9 billion. But then we see this really huge drop from 22 to 23. And one of the reasons is due to the shrinkage, the theft that you have seen documented quite a lot, especially over social media. So there are a few things that we do need to take into account when looking at this stock. And what I do like to do is take a quick look at the health of the balance sheet and the cash versus total debt. February 2019, 1.6 billion of cash on the balance sheet. Latest quarterly report, around the same 1.6 billion. So their cash position hasn't effectively changed massively over the last 5 years. And when we compare that to the total debt, what do we see? Well, their total debt, 2019, 13.5 billion. Latest quarterly report, around 19.3. So whilst their cash hasn't changed, they are taking on significantly more amount of debt, nearly 50% more over the last 5 years. And this is a slight worry, but again, it's something we need to take into account when looking at that all-important dividend safety and supporting financial metrics. Now, dividend safety score 90, very safe. Market cap 55.5 billion, making it a large cap company. For those that believe we're heading into a recession, well, how did they perform in the last recession? 07-09, they in fact increased the dividend in the recession. The recession sales essentially flat, which isn't much of a negative when you compare it to the other companies in the S&P 500 during the 07-09, as they were negative growth and much worse off than Target in terms of sales. However, in terms of the share price return, Target returned negative 61%, which was worse off than the S&P 500, which had a negative 55% return. So a bit to digest there for those who believe we're heading into a recession. Now, 51 years of paying dividends, increasing year on year. Why is that significant? Well, it gains the status of a dividend king. Any company which pays dividends consecutively increasing year on year, 50 years or more, dividend king status is given. Now, dividend growth, what do we like to see before we look at the numbers? I always say it, please, you need a minimum of 4% increase in your dividends, salary, or other income producing assets. Now, why the 4%? Well, the 4% is the average US inflation rate over the last 40 years in the US. Anything less in those categories, you are in fact taking a pay cut and losing your purchasing power. Now, 1.9%, not the greatest that we saw this year from Target. You could argue due to the poor performance and that poor bottom line net income that we saw. However, in the last 5 years, double digits, 10% compounded annual growth, 20 years, 15%. So some mixed news to take there, some positives, but also that really low dividend increase this year is a bit of a dampener. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average, 3.66 versus 2.42. So this is one sign of undervaluation. However, as always, never look at any model in isolation, and we'll draw our conclusions towards the end of the episode. Forward PE, 14 versus 17, another sign of undervaluation. And we can see here it is trailing the PE of the consumer staples quite significantly by 14.1 to 21. And as I mentioned at the beginning of the episode, it is right there at the 52-week low. However, make it clear, 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Earnings versus free cash flow. Regular viewers, you know we ignore the earnings. It is susceptible to manipulation by management through their accounting. So free cash flow is the far better metric. So what do we look for? Personally, 60% and below, because I believe that to be the sweet spot where companies can increase the dividends to double digits if they wish to do so. What do we see here? Well, for the large part, well below that 60%. In 2023, very significant. It is minus 121%, which is very poor. 2024, it is expected to be 71%. So there are a lot of fluctuations lately with this company, so do bear that in mind. They are going through some issues in the current moment. Earnings per share, again, free cash flow is what we look for. 730 in 2014, 1040 in 2022. With 2023, it has gone down to negative 3.27, which is not what you want to see. However, 2024 is expected to go back up to 619. Now, you could argue this is a large reason why we are seeing a dip in price, and now could be potentially a time to take advantage, but again, we will get to that towards the end of the episode. Sales growth, what do we like to see? We like to see around 3 to 7% growth year on year, as I mentioned. For the large part, until around 2019, it wasn't as good as we would expect. Negative sales for a few years. However, 2021, we see double-digit increase, as well as 2022, with 23 coming down slightly. So fairly inconsistent year on year, not what you really want to see from an investment. However, again, it really depends how the forward guidance is looking. Total sales numerically, 71 billion in 2014, 109 in 2023. Now, shares outstanding, we love it when companies do share buybacks, returning excess cash to our shareholders. So what do we see for Target? 642 million shares outstanding in 2014. 465 in 2023. So they do share buybacks fairly consistently over the period. So this is one positive metric that we have seen so far for Target in terms of share buybacks. ROIC, one of my 7 golden dividend metrics. Check the pinned YouTube channel to see the other 6. 10% plus is what I look for as a minimum, as it gives me faith management are able to effectively allocate their capital. What we see here is above 10% every single year, very consistently. However, Target, we can see, are hitting the high 18, 19%. 2023, it has dropped slightly. So forward looking, I would like it to go back up to the levels we saw for the preceding 9 years. In terms of operating margins, it is a place, or it is effectively somewhere that consumer retailers do struggle with. However, 10% is the minimum I would look for. And unfortunately, they haven't consistently been able to hit that. Some years where they have nearly hit that, but I think 6 to 7% isn't exactly what I'd be looking for. 2023, in fact, it's dropped to 4%. And why this is fairly significant is because the lower the operating margin, the more that bottom line is going to get squeezed, which then does essentially affect that all-important dividend safety score. Again, free cash flow margin above 6%. And whilst they have managed that on some years, again, it's not very consistent year on year. Now, net debt to earnings before interest, tax, depreciation, amortization. 3 is the maximum we look for consumer retailers. 3 being the number of years it would take the company to pay off all their debt net of cash on hand. Whilst it has been below that, it has from 2022 started to creep up. However, 2024 is expected to start to come back down again, and this will affect that all-important dividend safety. So let's hope they can continue to gain control over this. Net debt to capital purely showing the percentage of a company's financing from debt as opposed to equity at 60% in 2023. Now, as always, if you do enjoy the content, smash that like button and do hit that subscribe if you do enjoy the content and want to have these videos directly dropped to your doorstep. Don't forget that bell button. And as always, if you do want to pick up your own valuation model to run your own companies in your portfolio through the Intrinsic Value calculator, do click in the pinned description below. Now, Graham's valuation, the first model, we have the stock ticker, earnings per share at 7.29, growth rate per analyst estimates at 19, fairly high, with that current yield on AAA corporate bonds, giving an intrinsic value of $164, showing some significant upside to the current trading price, and just slightly lower than that 52-week high, our first signs of undervaluation in our models. The second model, the multiples valuation model, we have companies in a similar sector and size, Walmart, Kroger, Dollar General, with our stock prices and the earnings per share. We get the average multiple of their PE multiplied by the earnings per share of Target to get a multiples valuation model of $158. Again, the second model showing upside to the current trading price and in the middle of that 52-week range. We then move on to the third model, the dividend discount model with our yearly dividends. Now, as we can see, they have had some years where they do some very strong dividend growth. However, the other years have been fairly flat. Forward looking, I've gone for around 4%, which is in line with inflation. Now, you could argue slightly higher, given the average was 12%. If you wanted to be more conservative based on the latest increase, you could be going for something lower than 4%. As always, if you do want to play around with these percentages on the whole model, do grab a copy below. DDM price, however, based on this is coming at $114.40. As we can see, roughly in line with the current trading price, just a few dollars shy. Then we get to the fourth and final model, the DCF model, where we have our free cash flows year on year, the average growth rate at 17%. Forward looking, analysts are expecting significantly lower at 2 to 3%. With our discount rate, we get the present value of future free cash flows and terminal value. Add the cash, subtract total debt, and arrive at our equity value. Divide by the shares outstanding to give a DCF price of $164. As we can see, again, showing upside to the current trading price, showing undervaluation, and slightly lower than that 52-week high not seen long ago. As always, do hit that like button if you do enjoy the content and do grab a copy below in the pinned comments. Now, the intrinsic value is essentially the average of the 4 models that we have just run through, giving an intrinsic value of $150. Now, we can see that is some significant upside to the current trading price. However, it is still below that 52-week high. Now, current price is around 120, so margin of safety. Now, if it hits the 3 targets, which I look for, wide moat, strong financial metrics, good forward-looking data, your margin of safety would be around 10%. Now, personally, for Target, given the economic conditions, the issues they're having with shrinkage, and just the way this company is downtrending, I would suggest a higher than 10% margin of safety. Now, personally, 20% margin of safety is something you could look for Target. This would essentially mean roughly at the current trading price, it would be a buy. So based on the current estimates and judgments we've run through in today's episode, if you were to lock in this price at around $120, you would be getting a margin of safety of 20%. For those looking at 25%, it would be around the $112 mark. As always, let me know your thoughts in the comments below. Are you looking to buy, sell, or purely on the sideline speculating? Wall Street are forecasting upside to the current trading price at around $148 over the next 12 months. As always, let me know your thoughts in the comments below. Hit that like button if you've enjoyed today's episode, and do subscribe if you want more of these videos delivered to your doorstep. As always, take care and have a great day.